Well, good morning. Hey, so this is actually 3 days in a row I've done this, but to be honest, today is going to be really kind of short. I wanted to go ahead and just kind of do a quick review of a couple articles. Actually, one was sent in to me asking my opinion about a 50-year mortgage landscape and what that's going to look like and what is a 50-year mortgage and stuff like that. So I was going to touch on that just briefly, about a 30-minute stream here. Got to hit the road, got a lot of meetings today, got to be at, but I still read the news every day, so I try to make time to do that. So if you're here, thank you for joining. Really just a laid-back atmosphere here for me just to kind of go over recent news going on in the real estate industry, typically aimed at talking directly to real estate agents. But to be honest, this works well for anybody that's kind of looking for real estate or wants to kind of go a little bit, get a bigger understanding about real estate and what that entails, and maybe you're wanting to buy or sell a house eventually. So this will help you be even an informed consumer, even if you're not a real estate agent. So I hope you see some value here. But yeah, so let's go ahead and jump straight into an article. I've got about 3 of them here I'm going to go through, and then I'll be logging out, let you guys get on with your day. So let's see, this first one, nope, don't start there. I'm gonna start with Redfin. Redfin actually released a article yesterday morning. It was Redfin's 2026 predictions. Welcome to the Great Housing Reset. So, I will say, we went through kind of what I would maybe reference as a recession, to some degree the past few years. But that at the same time, we had this crazy amount of inflation that outpaced the actual income of what people were earning to be able to afford homes. You've seen a little bit of an adjustment going on in the industry where that's now come back into scope, where there's some predictions that are happening in the economical world where it's talking about being able to make the affordability a little bit better, incomes rising up a little bit, home prices are stabilizing, coming down just a little bit in some areas. Interest rates as well coming down. So obviously now Redfin's coming out with a prediction for 2026. So at the very title here, this is published December 2nd by Chen Zhao and Daryl Fairweather. U.S. home buyers will start to get some relief in 2026 with affordability improving as income growth outpaces home price growth. Next year will mark the beginning of a long, slow recovery for the housing market. It says the Great Housing Reset will take shape in 2026. It won't be a quick price correction and it won't be a recession. Instead, the Great Housing Reset will be a years-long period of gradual increases in home sales and normalization of prices as affordability gradually improves. It will start next year with incomes rising faster than home prices for a prolonged period for the first time since the Great Recession era. So this has kind of been happening over the past year or two, where there's been a little bit of an adjustment going on. The interest rates have been kind of went up pretty high. They spiked up a few years ago. That was to curb the inflation from continuing to increase at a rapid pace, which would ultimately lead into a crash because the affordability would become almost impossible for people to buy a home. So that has been done to bring that inflation down. Now that is kind of curbed and that we've gotten lower into the inflation percentage, like typically 2 to 3% inflation month over month is what you're aiming for. Once they hit that kind of number, then they start reducing the interest rate. When that starts happening, they bring the interest rate down. We kind of get a little bit more of a, like he's saying, a reset here, where the balancing of the house affordability, the ability for interest rate to be, favorable, and then at the same time, the income and job market, it begins to catch up with that inflation. So you end up having this slow transition time where the market begins to, we call stabilizing. Never really stable. It's economics, supply and demand, always kind of an ebb and flow, but it's a little bit more of a stabilization where it holds its line a little bit better. Prediction number 1 is mortgage rates will dip to low 6% range, one factor improving affordability. Mortgage rates will continue their slow slide but remain high relative to the pandemic era. The 30-year fixed rate will average 6.3% for the entire year, down from its 2025 average of 6.6. So 0.3% reduction. Honestly, anytime a reduction happens and it settles in at a rate that kind of holds that line, people tend to be a little more comfortable with that. So they get a little bit more comfortable with going out and buying homes or selling homes because they realize that's probably the new norm. And look, the pandemic era interest rates, we're probably never going to see those in our lifetime ever again, right? So this is going to be kind of the new norm, right around that 6% range. So I would say this is probably very true from what I've even seen in my local market, what's going on with our prices and how long homes are staying on the market, those type of things. I would say this is absolutely true. A weaker labor market will lead the Fed to cut interest rates in 2026 and bring monetary policy to a more neutral place, which should keep mortgage rates in the low 6% range. Prediction number 2, home buying affordability will improve as wages grow faster than prices. So we expect the median U.S. home sale price to rise 1% over year in 2026. Prices will tick up only marginally because still high mortgage rates and prices, along with a weaker economy, will curb demand. So these type of adjustments do take a lot of time. The Fed is not trying to drastically reduce the rate to spur on so much crazy buyers that the supply and demand begins to tilt again, where then inflation triggers. So a slower change, like a slower reset, is usually where I'm saying like we have a more stable market. So yeah, that's the strategy of playing this game. They're trying to bring that stability, get everything to catch back up and have kind of some equilibrium there where everything kind of balances out. Wages will grow faster than home prices in 2026. So that's that balancing act, that home affordability holds, the house price value holds, income gradually rises up to meet that threshold. You end up having a stable market, buy sell market, it kind of neutralizes, and then it could kind of go back and forth depending on what happens there. Prediction number 3, home sales will rise 3%. We predict that sales of existing homes will end 2026 up 3% from 2025, with sales coming in at an annualized rate of 4.2 million. Home sales will inch up in 2026. You kind of see what's going on. This is the number of existing homes sold seasonally adjusted annualized rate. So 2020, we're at 5.6, 6.1, and then we've kind of come down and kind of stabilized here, the 23, 24, 25, and a little bit uptick there on 26. So a little bit of a rise. Prediction number 4, rents will rise as demand for apartment rises and supply falls. Demand for apartments will rise as supply falls in 2026, leading to rising rents in many metro areas. Nationwide, we expect rents to rise about 2 to 3% year over year by the end of 2026, roughly the pace of inflation. So the supply of rentals has slowed. They've not been building as many rental units, so there's not as many available. So that supply and demand. So when there's not as many, rent goes up, so the demand is higher, so that begins to happen. So when that begins to happen, when rents begin to rise, that makes the mortgage market increase, because now the affordability to buy the home becomes a more likelihood, because the person's going to pay a lot more money in rent. Why not buy if you can, right? So that brings that into balance as well. So that interest rate doesn't matter as much when rent rates go higher, because the cost to live in a rental is going to outpace what the higher interest rate is, what we call high. To be honest, we're at the historical norm, but what we would consider high now. As rent goes up, that affordability index makes people lean more towards buying homes. So that is another factor. So this is probably very true. Prediction number 5, high housing costs will reshape households with more roommates and fewer babies. It says the improvement in affordability won't be enough to immediately boost homeownership for young families. Gen Z and millennial homeownership rates flatlined last year. So what basically is happening here, they're looking at more people that can't afford homes moving in with their parents. The parents then probably going out and maybe possibly buying a bigger place to accommodate multiple families. This is rare for America. Like, that's not a common thing that you have multi-generational families living under one roof. But I will say in a lot of other countries, that's not actually that odd. There's a lot of countries that is kind of normal. You first start out with your little family. You might move in with your parents, and there might be 3 levels to the house, and certain people live on certain levels, that kind of stuff. That's kind of normal in a lot of other countries, not very normal in America. We blaze our own trails, we go out and do our own thing, we end up buying houses and moving out on our own, but then we kind of get in financial trouble, and we end up having to go back and moving back with our parents and kind of do the multi-generational thing. So with the homes being so high in the cost, some people are doing that, which then parents then are deciding that, hey, we need to buy a certain type of home to accommodate that may happen. So the next 5 years, it would be interesting to see what happens, right? When people graduate college, do they come back home and live with them for a while? If they do, the parents are going to be deciding what kind of home they need. They might not be downsizing as quickly as they were in the past. Prediction 6, affordability crisis will unite policymakers across party lines. Voters in the November election, especially young ones, made it clear that lowering housing costs is the top priority. Not only are sale price and mortgage rates high, but the total cost of home ownership is rising due to skyrocketing insurance premiums and the likelihood that utility costs will surge due to scale AI-driven data centers. So there's probably a lot more, because everybody feels this. It doesn't matter what party affiliation you're part of, right? The cost of living is felt by all people. So that is going to be a major draw into going into any election season. How do we fix this problem to make the affordability for home ownership possible for those that can't afford it? How do we bring balance back to all categories of life, food, utilities, those type of things? So that does bring in the two parties kind of coming together more on policies. Each one has their own agenda, obviously, but it does bring people back into the central fold there, where they'll make compromises on either side to come to some kind of resolution that brings peace and stability into our economy. So hopefully that's what we see. Prediction number 7, more Americans will refi and remodel. Very true. As that interest rate goes down, like there's a lot of people the past 3 or 4 years that have bought, and they have bought in the higher 6% range, that will probably go back and refinance. So it's a good thing to talk to your homeowners about refinancing. Remember, it's not always about making a deal. It's also sometimes about just providing a service. And that's something you can do. Your sellers that bought back in, 2023, 2024, that had a higher interest rate, it's worth making a call and just saying, hey, look, interest rates are 6.3 roughly. You had a 6.8. Here's what you would kind of save. I'd encourage you to go talk to a loan officer, just looking out for you as your agent. That's a good touch. That's a good relational type reason to call them and engage with them. Maybe you haven't spoken to them in a while. That would be a great touch with them. Another thing is the remodels. Yeah, a lot of people are doing this to help increase, increase their equity that they have in their house. Prediction 8, New York City, outskirts, Great Lakes region will be hot. Zoom towns like Nashville and Austin will not. So housing market most likely to heat up in 2026 is New York City suburbs, including Long Island, the Hudson Valley, northern New Jersey, and Fairfield County, Syracuse, New York, Cleveland, Ohio, St. Louis, Missouri, Minneapolis, Minnesota, and Madison, Wisconsin. Then on the flip side, housing markets most likely to cool down in 2026, Nashville, San Antonio, Austin, Fort Lauderdale, West Palm Beach, Miami. We'll see. I don't know much about those markets, but they're using data. Prediction 9, climate migration will go hyper-local. As climate-driven events like hurricanes and wildfires become more frequent and intense, climate will become a more popular reason to move. But people won't necessarily make big moves like from coastal Florida to the Midwest. Instead, we expect some people living in especially vulnerable neighborhoods to move to less vulnerable parts of the same metro area. So there is a lot of that. I mean, climate, like tornadoes and hurricanes, they do factor in. People are very much aware of that, especially if you're moving to an area that is prone to those type of things. People do want to know what that looks like. But again, on the previous live stream I did, we talked about kind of how Zillow's rolled back and not having this kind of data on their portal anymore, but they're providing sources for you to go and verify and check those things out yourself. Same thing I would advise you guys as real estate agents. You don't need to be the one telling everybody what the data is, but you do want to tell people how to find that data, because it does help them, navigate where they're going to be comfortable living, and ultimately that's a good service that you can offer them. So prediction number 10, NAR, which is the National Association of Realtors, will let local MLSs call the shots, sparking consolidation. This is a lot of stuff's going on with NAR. I'll cover this on another live stream. We don't have time to do that today. It's time-consuming, confusing, and inconsistent for the National Association of Realtors to write rules for 500 local multiple listing services, MLSs. NAR will step out of the role of industry rulemaker and let local branches create rules about how homes are listed in their markets. Something has already started happening. NAR, for its part, will focus on advocacy. Putting local MLSs in the driver's seat will accelerate consolidation, with many smaller branches joining bigger networks. This creation of larger regional MLSs will bring clearer rules, faster innovation, cleaner data, and better experience for real estate brokers, home sellers, and buyers. Right now, if you're in the real estate industry, you have all these weird silos of MLSs all across multiple states. And as a realtor, you don't have access to all the data across your state that you're licensed in, and that is crazy. Honestly, I would love to see more of a broader MLS across states, because I think having access to that data is very crucial for an agent to be able to help navigate their buyers and sellers better. So I'm an advocate of that. Obviously, you don't want to go so broad that it loses all local feel to it. There's a balancing there, but I will say for the most part, though, you probably should consider talking to your board about opening up the silos a little bit, giving more access to data. And prediction number 11, AI will become real estate matchmaker. Generative AI will increasingly help people decide where to move. identifying cities, towns, neighborhoods, and homes that fit users' budgets and lifestyle criteria. So yeah, these tools will allow house hunters to find homes with niche features. For instance, Redfin agents expect wellness features to become a defining feature of next year's high-end market. What's going to happen is that the search is going to redefine itself, and AI is going to be more and more integrated into what people are looking for and know better about what people are looking for, and then it will also do better at delivering those results to those people. So I think what will end up happening is these leads that are coming in through your portals, if this goes right with this prediction, could become better leads if AI is at play here and people are giving more information. So kind of being familiar with that and seeing what's going on is very, very crucial. All right, some actionable takeaways that I've kind of just noticed in here, pulled them out real quick. What I would say is if this is talking about the great housing reset, that means that you as a real estate agent really should understand how to set buyer expectations, seller expectations based on this information. What does this mean for your clients? This slow, gradual improvement. What I would say is emphasizing that this is not a crash. That's not what we're talking about. But what we're talking about is the affordability is going to be improving as the wages outpace home price growth. So that's what's happening here. So it's a reset to what we've known in the past couple years. So not a crash, an adjustment, a reset, and that's what's happening. So making sure you're in front of your clients and giving them the correct information, so when they're reading articles and seeing the headlines, they are informed by what's happening locally and also as a nation. So the next thing I would say is this: target current homeowners for refinances and remodeling services. That's what I just said that earlier, but I would say that is absolutely true. Making that personal contact when you know a client has a higher interest rate because you closed with in the past few years, and letting them know, hey, this might be a good time to reach out to your banker and see if a refinance makes sense to you. It's a great touch point. It's a great way to kind of offer a service outside of just trying to get a sale from somebody, and they will talk about it. They'll say, hey, my agent called me and let me know about the interest rate and advised me to go get a refinancing check, and hey, I did, and I'm saving this kind of money, and that's a testimony that leads to referrals, right? So this is a referral-based business first. And then I would say, in regards to Gen Z and millennials and those type of buyers, if you come across somebody that is really struggling, how do you help them? How do you advise them, right? Well, there's a couple things I would say. Maybe they can't physically afford the home's prices right now. Maybe they are not married, maybe they're single, or maybe they are married and they need to simplify their lives. Well, talk to them about maybe co-buying with friends, or moving into multi-generational homes with family, or those type of things, or looking at your geographical location and saying, is this area more expensive, or if I move 10, 15 miles outside of that area, is it cheaper and can I afford it? Having these kind of dialogues with the Gen Z and millennials that maybe don't have enough income to afford the homes will help them kind of think through their life and their finances and figure out what they can afford to help them get on better footing. So in the near future, they can buy. Because especially if you come across somebody that wanted to buy and they get denied for a loan, they just couldn't afford it yet, that's the time to have that conversation. So the first time buyer, this is a great strategy to kind of help them along the way. I think it's very, very crucial. Next one I'll go through here. I got to wrap this up real shortly. So I'm going to skip this one. I'm going to go straight into understanding the legal landscape of 50-year mortgages. I think this is just something, we're hearing a lot about this in the news. A viewer sent this to me yesterday, and I said, yep, I'll go through it. I think they were from Virginia, so they must have pulled this article for me. But this is December 2nd, 2025, and this is the Virginia Realtors website, virginiarealtors.org. This is by Sean Oak. So Sean, thank you, man, for putting this together, because it is a good basic understanding of what is a 50-year mortgage. You might have heard this in the news, because right now we have the 30-year fixed mortgage. So there's a lot of talk about what is a 50. You're going to hear this more and more in the news. So let's just briefly read this article, and I'll kind of break down my takeaways from this. In recent news stories, it is likely you've heard about the idea of a 50-year mortgage. The current administration has introduced this idea in an attempt to make owning a home more affordable. Yet, would a 50-year mortgage really make buying a home more affordable? Here's the thing. Yeah, you're going to save some money on this, and you're going to take your payments, and you're going to go out 50 years instead of 30, amortize that out, and your payment's going to be lower. But now the reality is, the longer you stay in that home, the more interest you're paying. Therefore, at the end of that 50 year, you've paid a whole lot more for that property. So that's the argument. I'm not saying it's a bad argument, and maybe it's a case by case basis. Some people it might make sense. But being aware of this as a real estate agent and being able to articulate and talk through these scenarios is very, very important. But I will say this, 50-year mortgages can't even happen yet. They're not even legal, but I think he gets into that here. That very next sentence. It says 50-year mortgages are not currently a reality because it would be unlawful for a financial institution to offer one as a qualified mortgage. The Dodd-Frank Act, which became law in 2010, created certain criteria for qualified mortgages under its ability to repay rule. The reasoning was to curtail predatory lending practices. In other words, I'm not going to go in here and manipulate all these numbers just to make a loan. It's not that I'm just as a lender, I'm just going to do whatever I can to make money, and at the expense of not being considerate or knowledgeable to help the actual client. So Dodd-Frank put a lot of rules and stipulations in there to avoid predatory type lending tactics. So 50-year mortgage opens that up a little bit to have a little bit more of a landscape to do some of these creative financing options. So there is a risk factor there that could open the door to some of those practices. Now, Dodd-Frank obviously has some rules in place to stop that from happening, but when you start changing terms like this, things like that could open the door where that could happen. The ability to repay rule was implemented because prior to the mortgage crisis of 2008, lenders were using loose underwriting rules to qualify borrowers for a mortgage, including failing to verify the consumer's income or debts and offering consumers introductory teaser interest rates that could jump to unaffordable levels after the first few years. This happens rampant. This is what caused a major crash. Because what was happening, man, people would take people's word. You would go in and get approval, and now we have like this pre-approval and we have actual approval. Back then, it was like approval. You basically just told them what your income was, and they went with it. They would take your credit score and run with it and give you a loan on that, because then they would take that loan and then resell it, and the people could never afford this. And then what they were doing to get that credit score lower and the payment lower, they were offering a lot of crazy arm loans where they would just go at this rate and they would spike way up to the affordability was just impossible for the people. And so then you had a lot of what was called forbearance payments, people that were calling their banks saying, I can't afford this, and the banks were having a hard time, affording foreclosures because it costs a lot for the bank to do so. And so then the people could not do that. So what ended up happening, you had all these negotiations to try to keep people in their homes. So banks were losing money, buyers still could not, or sellers could still not afford their homes. So it was just completely out of whack. Foreclosure market skyrocketed, all because of these predatory lending practices. So Dodd-Frank was addressing all those things, right? That was the part of this ability to repay rule. That's what this was. These risky loans were insured and purchased by Fannie Mae and Freddie Mac, which ultimately became a huge problem, as we all remember. As part of the Dodd-Frank Act, qualified mortgages are presumed to be compliant under the ability to repay rule. 50-year mortgages are not compliant because they may not be great for consumers. Again, case by case, we don't know, right? I would like to see more information about what this means. So I'm not going to be able to definitively say 50-year mortgages are a bad idea. I don't know. I don't know exactly what the rules will be that Dodd-Frank will come back and do, and what the government will come back and put in place for these things. We don't know. But right now, it's something we need to keep in our minds about. This is being talked around as a possibility. What is the use cases for these things? How does it come into play? But remember, this stuff, it cannot be used right now. If you took a $400,000 loan at 6.25% interest over 30 years, the consumer would pay approximately $486,750 in interest. That's already over 100% of the principal amount. Now, if we take that same loan amount and amortize it over 50 years, the total interest would be approximately $951,800. That's almost double the amount of interest paid. See, that's a significant amount of interest paid. Now, most people don't own their home that long, so that's probably the argument on the flip side of this. When comparing a 30-year term to a 50-year term for the same $400,000 loan, the consumer would have about $200 per monthly mortgage payment. However, saving $200 per month may not be worth the extra interest over the life of the loan. That's the argument. You got to balance that. It's a case-by-case situation. There are also issues with generating equity over a 50-year term. This is true. The longer the term of the mortgage, the more overall interest the consumer pays, and the more those interest payments will be front loaded. Therefore, with a longer term, it would take the owner a much longer time to generate any significant equity in the property, right? You're not paying as much equity every payment you make. So that equity you're gaining is very marginal. So you're reliant upon what? Inflation. You're reliant upon your equity coming, that the market increases, the home increases in value. So the question is this: if a recession happens, what happens to the person that has a 50-year mortgage and that equity is eaten up because the market crashed? So any little bit of equity they had, market crashes, home prices go down, they lose that equity. Now what? They're underwater, right? So as you extend that term out to 50 out over 30, the risk along with that increases. So the person that's doing this needs to understand that you are kind of making a statement. I want to stay in this house a lot longer than I planned on doing so. And I need to be okay with that if something was to turn. There's a little bit of a gamble going on here. All right, remember, current law does not permit qualified mortgages with a 50-year term. Right now, the idea of a 50-year qualified mortgage is just a suggestion. All right, so a couple of takeaways here. So really right now, if this talk is happening at all, you need to make sure they just understand that it's not even possible. That 50-year mortgages are not currently available. So that's not even an option for anybody. That would violate the 30-year limit set by the Dodd-Frank Act. So they're not even possible right now. A lot would have to be changed on the law side to make this a possibility. So if this talk's circulating, educate your clients that, hey, right now this is just talk. You can go over some of the points I just made and kind of inform them, but in reality, it's not available yet. Educate buyers on the major financial risks of a 50-year term, right? Highlight to them what we just discussed. You know, what is this slightly lower monthly payment comes at you for? Like, if I save $200, what's the risk, right? I'm nearly doubling the total interest that I'll pay over the life of that loan. So this comes into the financial counseling aspect, a long-term cost of a home. These are conversations you need to be having with your clients. Make sure they understand. Will a 50-year mortgage happen? I don't know. If it does, let's be ahead of the game here so we can understand it, so we can articulate the risk associated with that before it actually happens, right? And also, it's a great thought exercise. If we're sitting here trying to understand what happens, guess what's going on? As we discuss going into a 50-year mortgage, we're getting better at understanding how mortgages work, what the risk is for a 30-year interest rates, and how equity works. We begin to critically think through these things. So even if a 50-year doesn't happen, we begin to think through this in a different way as a professional to help guide our clients correctly. Maybe a 10-year, a 15-year, or 20-year mortgage is better. What is those cost savings to a buyer? Can they afford to do so? Because you're going to be paying a lot more on your equity if you went down with a lower term. Focus the buyer conversations on wealth building. Okay, so that's really where we're at. If you're buying a house, there's a future, gain that you're hoping to get at some point in equity. So you need to have these type of conversations. So focus on all of the conversation when you start talking about this is like, where do they see themselves 40, 50 years from now? When do they want to retire, and what does that look like? What type of home would they want to have, or what kind of nest egg would they want? Those type of scenarios need to be part of the conversation when you're dealing with a buyer. What is it like to actually live in this home 5, 10, 15, 20 years, and what does my wealth look like at the end of that term? Okay? So there you go. That is 2 articles. That's all I have time for today. I've got to hit the road to some meetings. If you watch this, I do appreciate that. Obviously, if you're watching on YouTube, please like, subscribe, ring the bell. Do appreciate that greatly. And also, just as a reminder, I am streaming also on Twitch. It's a new platform. I've never done it there. Definitely not the same type of category and content that you see on Twitch, but I do like the way that system works. So if we can use that, that'd be awesome. I like the engagement there. So thank you for joining me today. I do appreciate that. Have an amazing day, and we'll see you next time.